The broadcast is now starting. All attendees are in listen-only mode.
Hi, this is Chris. Hello, everyone. Welcome to our monthly Connect series. This is June the 12th. Hope your summer's going well. Let's go ahead and get started. And just as a reminder, our attempt is to be your 30-second solution, that you can see a chart pattern in 30 seconds or less and see what type of action that we're suggesting, and you can decide if it's fits your risk tolerances or not. As another reminder, we start off each month with a webinar that we're not bulls or bears. We are just bullish on opportunities, and I continue to believe that opportunities are very great in front of us, very exciting, what I think will take place between now and the end of the year. So I want to start off with the beginning of the webinar, just as far as what I continue to feel is the major influence or impact on the marketplace. And as a reminder, as we look back, this is a chart of the Dow Jones on a monthly basis to where we applied Fibonacci extension levels to the highs in 2007 and the monthly closing lows in 2009. And as a reminder that when the Dow hit the 161 level, and again, that's a 61% expansion or increase from this light blue trading range, the Dow hit this level, which was around 18,259, and continued to bump up against it for months. But you can see it was a really strong rally taking place, and then once the 161 level came into play, it traded sideways for a good period of time. And actually, that period of time was in excess of 20 months. Now, the key is once the market was able to close above the 161 level, you'll see it actually broke above it, came back and used old resistance as new support. It took off and a 50% rally followed. So I think, from the Boy Scout motto is be prepared. And so to me, it's to be prepared in several things. Be prepared that a trading range can take place when certain Fibonacci extension levels come into play. And also be prepared that when a breakout takes place, particularly to the upside, you really want to be long and strong and take advantage of upside breakouts. So you can see this really strong rally took place once the breakout happened. So as a reminder and an update on a current chart on the S&P, we applied the same Fibonacci to the 2007 highs and 2009 lows, and the 261 level came into play in January. And so you can see on a monthly basis, it just ran into, on the SPY, the ETF of the S&P, it hit the 285 level and stopped on a dime. It had been soft for a few months, so we're in a trading range between 253 and 285. You can see that this is a 6-year rising support line from 2012. It was tagged a couple of months ago, and that support held. And so we still remain in this trading range. I personally would be very surprised. Last time it hit the 161 level, it traded sideways for 20 months. I would be very surprised to see it trade sideways for that length of time again. So from an S&P perspective, you can see that it's trading around 278, 279 with the top of the range at 285. So it's just a couple of percent away. The Dow looks the same when we apply the Fibonacci extension levels to it. The 261 extension level for the Dow comes into play around 26,700. So its trading range is between 23,360 and 26,700. It's a little bit further on a percentage basis away from the top of the trading range. But again, here's a 3-year support line that had come into play. You can see it was tagged a couple of times in the prior 2 months. This would be the month of June. So it's near the middle of the range and a little bit farther away from the top of the range. So in my humble opinion, I believe that the impact to the broad markets, the larger indices from the NYSE, the Wilshire 5000, the value line geometric arithmetic index, the Dow and the S&P and the transports, they're still being highly influenced by this 261 extension level. And this can be seen in this 8-pack. So just to kind of run through what charts we're looking at, we have the S&P in the upper left, followed by the Dow, the NYSE, and the Dow Jones Transportation. So the pink horizontal lines were the highs at took place when the 261 fib levels happened. So you can see that each of these indices are still several percent below the highs that took place in January. And just an FYI, the red rising line on each of these charts is the 200-day moving average. So on all of these indices, the long-term trend still remains up, despite the sideways action, particularly from the charts on the top row, and they're all above their rising 200-day moving averages. So from a long-term perspective, nothing that's, despite being maybe boring and not having a lot of net action up or down, the long-term trend still remains up. Now the bottom row of indices is a little different story. So in the lower left is mid caps. The second one is the Russell, micro caps, and the Nasdaq 100. And I shaded in green, these were all the highs that took place earlier in the year. So you can see that micro caps just of late, these are daily charts, so recently just pushed above the highs of earlier this year. Russell and the micro caps have been well above it, several percent above all-time highs or that took place earlier this year. And the Nasdaq is right back at testing its highs of March. So I don't know that we've seen this that often, but it is unique that the large caps and the large indices are lagging, but the leaders are mid, small, and micro. And tech is trying to join the crowd. So as you guys know, we're participating in these indices that are showing the greater strength, being the small and micro caps. So this is an example kind of where the strength has been coming from of late. Small and micro were purchased on May 10th, so they've been owned for roughly 5 weeks, and excuse me, just a little bit over a month, not quite 5 weeks. But you can see the performance since then. Since that was purchased, micro caps are up around 560 basis points. Small caps are up 4.81%. Mid caps that we just mentioned are just now breaking into all-time highs in the last couple of days. They're up 377. But you can see the big caps being the S&P is lagging the small and micro by a pretty good percentage. Micro has almost doubled the S&P during that time frame. And then as you really broaden the horizon, as you know, the S&P is 500 stocks. The NYSE is a couple of thousand stocks plus some closed-end bond funds. But you can see that indice is the lagger of the pack, up just 1.3% in the last 5 weeks. So I'm glad that we're in the top two that are performing well on a percentage basis, picking up 4 to 5% in about 30 days, but also reflecting a nice relative performance over the broad market. As a reminder from a good friend, Ryan Dietrich, historically, this looks at the past performance in blue since 1950 of the S&P 500, in grays the past 10 years, and the yellowish copper color is the past 20 years. So June has historically been one of the softer months. You can see its performance, with July looking a little bit better. So May and June are typically fairly soft. On a historical basis, I will say it's good to be aware of these things, and I want to share them, with you. But I think there's greater influences to really tell us how the market's doing, such as the advanced decline line we'll look at. So this, despite this historical seasonal softness, is not keeping me from taking long positions. But then as another reminder, whoops, sorry about that. This was another cool chart, I think, from Ryan that shows 6-month windows of return. So, there's the old adage of sell in May and go away. So the 6-month window from May to October is the lowest performing 6-month window over, this is a period from 1950 to current. So, we're looking at almost 60 years. You can see that the window from May to October has an average gain of 1.5%. June's not a heck of a lot better, but it has improved. At the average total return of the S&P during that window is 2.8%, and it's up 65% of the time. But again, despite these historically soft numbers, when certain indicators are still moving high, I'm comfortable with taking some long positions. I think this is more important for me. I know it's more important to me than seasonality. and it's the NYSE Advanced Decline line. This is, common stocks only. The AD line since 2009 has remained inside rising channel 1. As all of you know, I share this updated every week in the Global Trends Report. And you can see the trend, it's at all-time highs. It's actually knocking on the door of the top of the rising channel at 2. And so this continues to send a positive message to the overall marketplace. So some of the market indicators can show actually a thinning of some of the shares that are being traded, and it's true. But it is nice to see that the advanced decline line is continuing to push higher. And so this, to me, is a positive aspect, sending a good signal to the broad market. This is just a narrower look at the AD line on a daily basis. You can see back at the highs that took place in January that the AD line did fall swiftly for, the first 10 days or so of February. This created a higher series of lows, and then it did push above, right in here about a month ago, pushed above the January highs, and then continues to accelerate to the upside. So this is continues to send a positive message from the daily AD line. Here's just a global snapshot of indices around the world. Just real quickly, if you want to see what these indices are or look back on this, this is the key to what the asset is. So this is the S&P. Middle chart on the top is the Dow. This is the Nasdaq 100. In the middle row, this is small caps. Here in the middle row is mid caps, and this is the value line geometric. Then the bottom line the bottom 3 charts looks internationally. This is Germany, the DAX index. This is France, the CAC 40, and this is the London FTSE 100 index. So you can see that all of them remain in rising channels. The blue circles reflect that they are testing breakout levels across the board as the trends are high. They are very much close to the upper end of rising channels. In and of itself, that is not bearish whatsoever. This would just be a place that bulls would prefer not to see selling get started. Bulls would love to see breakouts or a continuation of trends of these continuing upward trends. If they would break out, you could most likely going to see advanced purchasing of assets, despite the seasonal weakness that is at hand. One of the things I'm keeping a close eye on that could send a positive signal to the market is actually sent a negative one for a while, which hasn't stopped it from going up. But this is the RSP-SPY ratio, which is the equal weighted cap weighted ratio of the S&P 500. And so to present the best bullish case possible, one would prefer to see this ratio going up so that what it would be representing is that the broad, all of the stocks in the S&P 500 that are equal weighted are actually doing better than just the big stocks. So what this is really saying is actually just the big stocks are powering the S&P's move when this ratio is heading south. Now it is testing, it's been heading down for well over a year, about a year and a half, and it's testing the lows of late 2015, 2016. You can see that was tagged a couple of months ago, and has had little net movement over the last few months. But if this ratio would break out, the ideal bullish case for the bulls to really load up and back the truck up would be for the Dow and the S&P to break above 261 levels, and to see the SPY ratio break above falling resistance. So if you kind of want to look at what would be a signal of really a positive case that we could end this trading range, these are a couple of things that you'd like to see. And I think right now with the AD line breaking up to new all-time highs, until that would turn lower, which it has not, to me the risks to the downside are still very muted. We need to see the AD line start showing deterioration to be sending a caution message to stocks. So we want to look at the case of leadership and kind of what's happening. This is a chart I found from the Lethal Group that I thought was interesting. So let's kind of just think about this chart for a second. This is the S&P 500 X technology. So they found a way to strip out just the technology stocks, and then they compared it to just the overall S&P and created a relative strength index. So you can see this chart goes from 1990 to current, so just short of 30 years in length. But in the 1990s, this was falling. So what message was that? This was reflecting that tech was really a huge influence to the market. And so in other words, when you strip the tech out, you found that this was weak. Or if you could flip this around, it would reflect that tech was very strong. And so we're seeing this, again, we're not near to the levels of 2000, but to me, this is why I'm trying to focus and share often charts on the semiconductor index, the Nasdaq Composite, and the Nasdaq 100, because those are the leaders since the 2009 low. And so we really want to watch leadership from these key indices, because if they can continue to do well, it's going to create a positive influence. So, with that in mind, this two-pack on the left looks at the Nasdaq 100, and on the right is the semiconductor index. So these would be two of your key leaders. And you can see that this was the high in March in the Nasdaq 100, and it's knocking on the door, attempting to break out to new all-time highs this week at 1. So if the Nasdaq 100 can break out, that's a positive signal, in my opinion, obviously for tech, but also it can send a good message to the broad markets as well. On the right side is the semiconductor index. They're close to knocking on the highs that took place in March, but they're not quite there. So again, we want to really watch what happens to the Nasdaq and the semiconductor near the highs that were achieved a couple of months ago at 1. And as you know, in both the global dashboards and the sectors report, we're continuing to share these on a weekly basis, because I think there's nothing more important than to watch how leadership is doing. And so one of the things that I share each week, also in the sectors, is the Nasdaq Composite Index. And I still find this chart intriguing. This is the Nasdaq Composite going back 20 years. And the thing is that the index has spent the majority of the last 20 years inside rising channel 1. The trend remains strongly higher for the Nasdaq. It's intriguing to me that it had 9 years down, and that 9 years down took it to the bottom of this channel into 2009, and then the Nasdaq has had 9 years up. And so the 9-year rally is taking it back to where it's kissing the underside of the top of the channel at 1. And also this channel, the red lines are about 7 years of age. So it's testing breakout levels of the 18-year channel and the 7-year channel at the same time at 2. So if we could get the Nasdaq Composite to break out, would send a really positive message to that sector. And of course, the bullish case, this would be one of the last places that the bulls would want to see the 9-year pattern repeat or selling get started at 2. So right now the trend is solidly up and it's attempting to break out, and so it's still sending a very positive message from tech. Just a big test is at hand. So I thought it was kind of interesting just to look back of the rally that's taken place, even though the S&P is not at all-time highs. This is a look at the CNN Fear Greed Index. And there's two of them here, but if you'll notice, they're both dated. And this just shows from April, May, June, in 60 days, there's been a significant change in sentiment. So back in April, on April 3rd, you can see that people were very fearful. The Fear Greed Index stood at 8 at the time in early April. And now roughly a little bit over 60 days later, they're feeling more confident. It's now into the greed level. It's by far not hitting the extreme greed levels, but people's feelings of confidence have changed in the last couple of months. And so there's something to just always continue to watch is investor attitude. But a significant change has taken place sentiment-wise from this indicator. Another one that I shared over this past weekend in the sectors report I thought was interesting. This came from sentimenttrader.com. Was the ratio, this top chart is the ratio of the S&P 500 to 10-year Treasury futures. And then on the bottom is the asset allocation from the American Association of Individual Investors. Their allocation to stocks is in blue, and their allocation to bonds and cash is in red. And so we're just kind of looking for big spreads, but you'll notice where the ratio of the S&P to Treasury futures stood in the year 2000. Then you'll notice how wide the spread was. And we know that what happened after 2000 stocks rolled over. We actually see that the ratio was lower in 2007 than 2000, but you can see the spread below was getting wide. So now we're above 2007 levels currently on the ratio of the S&P to 10-year Treasury futures. We are still below where the level was in 2000, not much lower on a percentage basis. And then the spread between the two is the widest since 2000. So this would reflect that mom and pop, the average investor, are getting fairly confident in the marketplace and getting fairly fully invested in stocks over bonds and cash. So with when sentiment levels get high, when the markets are testing, like the Nasdaq Composite is testing the top of a 20-year channel, we always, going back to the Boy Scout thing, we want to be prepared of what to look for at price levels if some selling pressure came in to impact your stops and to impact your asset allocation models. So this is something that we haven't seen in the lower chart for mom and pop when they're investing. We haven't seen this great of a spread essentially in the last 18 years. So with that in mind, there's a couple of big tests going on. As you can see, this top chart is the Dow going back to 1915, and this is on a monthly basis. And then the lower chart is the 10-year yield on a monthly basis going back to the early 90s. Now, everyone, why there's no data in this bottom chart here is the system doesn't support that you're able to chart, for the most part, 10-year yields in this time frame. But the thing that does catch my attention is the trend in stocks is definitely up. This is a 70-year rising channel. In January, it did kiss the underside of that channel, and that's where we've chopped sideways. And then the trend in yields is also definitely down, and yields are testing the top of the 25-year channel at the same time that the Dow is testing the top of a 70-year channel. And you can see the last time that yields hit the top of this channel, also stocks happened to be very close to the top of the 70-year channel and ran out of gas. So these are other pieces I want to empower you with. These are not bearish charts, but this would be a case from your asset allocation that you wouldn't want to see selling take place at the top. And so far for 25 years, this is where yields have peaked. So we're going to see if it's different this time than what we've seen the last two times in these red bars for stocks and yields. Excuse me. So we're going to now switch from the stock market to the commodity area. I've shared this chart a couple of times. I'm going to continue to share it. And the main piece that I want to share here is that there has been somewhat of a cyclic time frame cycle in commodities. This is the Thomson Reuters Equal Weighted Commodity Index. And you can see that a couple of times the market seemed to be influenced, that it had about 8 years up and then 8 years down. It did tend to peak in the middle of this cycle and then may have bottomed in the early 2000s, ran up to around 2011. You can see that peak, giant head and shoulders top, and then the cycle's coming to an end. Now, I'm not going to invest, and I wouldn't encourage you to invest on cycles only, but this does show that there's a chance that commodities could, that have been so out of favor, perform poorly, that maybe from a cyclic perspective, they could do better. So the big test is taking place up there at 1, and so here's an updated chart that I'm sharing each week in the sectors report. And so the bottom line is the Thomson Reuters Equal Weighted Commodity Index has remained inside the blue shaded falling channel for the past 7 years. It's also testing its 23% Fibonacci retracement level right now. So this is a dual test of resistance. The long-term trend remains down over the last, they did bottom in late 2015 or 16 here, but there was a quick rally into 2016. So you can see that there hasn't been much taking place in the commodity index for the last couple of years. There's a chance this could be an inverse head and shoulders, left shoulder, head, right shoulder with a neckline at the 23% fib level. But this time I wanted to put in the 38% retracement level of the decline from 2011 to 2015. That if you could see if a dual breakout would take place, that should attract buyers. And the next Fibonacci retracement level is around just call it the 485 level. So roughly about 50 points above current prices, which would be around a 12% above current levels. So again, this is a key price point for commodities, just to see can they do something different and break out from this very strong dual resistance level that's currently in play. And again, if it does break out, we're going to look at a couple of different commodities. We are long at this time DBC, which is the way to play this on the ETF world. But there's also DBA out there that if this would break out, I'd look at owning some DBA, which is the commodity agriculture slanted ETF. So, there's no doubt that the U.S. dollar impacts commodities. And so if you're bullish the commodities case, you're kind of like this guy, you don't want this pattern to be true. So this is a pattern of the U.S. dollar weekly over the last 20 years. We've been sharing this consistently for several months. A cluster of support came into play early this year, even though a lot had talked about the demise of King Dollar. It hit this support and it rallied. So about 3 weeks ago, it hit the 2017 highs that took place in the fall. You can see this blue shaded area. So it's far from proven by any stretch, but as I look at this, there's a chance that this could be an inverse head and shoulders in the US dollar. And if it is, it's incomplete, that the right shoulder would need to decline in the US dollar, down to, roughly the 91 level. It's at 93.55. So not a big decline. But again, to prove any head and shoulders, whether it's an inverse or a right side up head and shoulders, the neckline becomes important. So 95 is still heavy resistance for the dollar. But if the dollar would decline and break above the 95 level, it's most likely going to attract buyers. It could push itself back up to at least 105, which would be a 10% rally. And if this pattern would be true, commodity people are probably going to be like this guy. They're going to be a little ticked, and so this is far from proven, but I want to make you aware that there's this possibility. I'm not a commodity bull or a bear. I just, humbly, I would like to see commodities do well, just from an aspect that they've been so out of favor. The majority of people don't like them. Investment houses have very low weightings in commodities. So if commodities, this is my 38th year, I've seen them do both sides of the fence, strong rallies and big declines. So there are opportunities when commodities can turn higher. So I'm just interested in them from an opportunity perspective, not from just being bullish commodities, overall. So a big test for the dollar at the 95 level that commodity bulls do not want to see King Dollar break out at 95. Another big test for a commodity that is often looked at as a leading indicator is what Doc Copper is doing right now. As you can see, copper has been in a trading range between roughly 295, the blue level, and 330 in the upper. This is a weekly chart. So last week, copper had a really strong pop. You can see it was just narrow for week after week after week. Then once a little bit of buying came on, it had a pretty large percentage rally. But the rally last week took it to the top of the trading range and falling resistance at 1. So Doc Copper is not the holy grail or the sliced bread tool to determine inflation or interest rates or economic growth or any of the things along that line. But it's been very important. So, right now copper is testing the 2014 highs, this horizontal red line, and the highs of last year. So if copper would break out at 1, it could have its positive ripple effects for the commodity story. But the bottom line is, forgetting other ripple effects, I'd be interested in owning copper if it breaks out. And if you're open to owning such a thing, the copper, just as a reminder, ETF for this sector is JJC. So humbly, I believe that one of the most important commodities on the planet is crude oil. Some countries use crude oil almost as a de facto way to trade currencies and their wealth of their countries. So, when you look back in 2013, crude oil was at a high, just short of $110 a barrel. Then we had this huge collapse down to just in the low 20s. So I applied Fibonacci to the 2011 high. That's when the CRB index, the Thomson Reuters commodity index, peaked. Copper peaked at that time. Gold and silver peaked at that time. So I hooked Fibonacci to the 2011 highs in crude and the 2016 lows in crude. And crude again, this is a monthly chart, hit the 50% level last month and created quite a pretty decent sized bearish reversal at the 70, just above the $70 level. And so it was trying to do well, tried to break above it, had this bearish reversal, and now it's slipped just a fraction below this couple of year support line at 2. And so far in this month, you can see it's this little notch on the right side is where its current price is trading. It's a little bit, below this resistance line with a bullish wick that's taken place. We're just short of the middle part of the month of June. So commodity bulls and crude oil bulls would not want to see a rally up here and a kiss of this and then weakness. If crude would break above the $70 level, above that 50% retracement, the whole entire commodity picture, I think, would like that. But they'd get concerning message if crude oil continued to be weak here at 2. So I wanted to show you something here. This is from Sentiment Trader. And these are the commodities that have extremes in sentiment, ranked from the most extremes and then going lower. They have a great product. This is one of their ways that I like to look to see how certain things are doing. So the most extreme sentiment commodity from their indicators is coffee. You can see with a different way they look at the right precious metals, then the franc, Bitcoin, Canadian dollar, crude oil, and hogs. This was just 1, 2, 3, 4, 5, 6, 7, the top 7 out of an extremely long list. But I wanted to pick on a few of the top ones here. And so we'll start off with coffee and just kind of show you kind of what they were referring to. So typically when the hedger's overall position is high over the last, this looks at over the last 9 years in coffee. When the overall positions are high here, you can see that coffee's been closer to a low than a high. I mentioned earlier that many commodities peaked in 2011 and coffee was no exception. But you can see on the flip side, when traders were positioned here, that's where coffee saw a really significant decline. It's kind of hard to tell how large of a percentage decline, but we'll look at the next chart. But I think that's over a 2/3, a 65% decline in that time period. Then we can see that the positions of the traders switched. Coffee had a low, and this was a significant rally that took place. It doesn't seem to look too significant, too large on a percentage basis, but it was. Then you can see the traders change their positions again, and that's where coffee peaked. A little bit of a low and a rally, and then again traders positioned here and coffee peaked. So when you look back now over the last 9 years, this is the most extreme, quote unquote, crowded trade that coffee traders have established in the last 9 years, with it starting to unwind a little bit. So historically, coffee is closer to a low than a high when traders are on these positions. So let's just look at a coffee chart. But let's go back just for a second here and look at 2016, you can see where the traders' positions were right in here. And now we'll look at the coffee chart. So in 2016, you can see that coffee, which was trading around 250, had declined to about 1.25. So let's just call it a 50% decline. Sorry, I said it two-thirds. So at least lost half of its value. It came really close to this rising blue line, which at that time was what, a 12-year rising support line. Made a series of lows for several months, broke above this resistance line, came back down, tested as support, and even though it didn't last a long time, this rally started roughly in the 120 range and rallied up to around 180. So on a percentage basis, you can see that's almost a 50% rally in a few months. So now we find ourselves currently the same long-term support lines in play. Hardly anybody likes coffee on a bullish sentiment perspective, and traders are betting that coffee is going to rise. A couple of weeks ago, coffee attempted to break out, and then you see now it's testing old resistance, as new support at 2. And you kind of saw a similar case here at 1. So the stage is set. I don't know that it's going to happen at all or when, but the stage is set for at least a bear market rally in coffee. You know, the long-term trend in coffee, you can see is down from 2011, lower highs, but we are testing a significant support area that we did see a 50% rally on. So for those of you that trade futures, this would be keep your eye on coffee futures. And then, a few months ago, a lot of the commodity ETFs changed symbols. So for most of the time, people that wanted to trade coffee were trading JO, but I believe now the new symbol is BJO. And so I'm going to continue to update this, and I'm really open that if coffee would act more positive and break out, to own a small piece of this. So on that list from Sentiment Trader was also the Swiss franc. As far as that, it was at a bullish extreme. So this is the Swiss franc looking back over the last 11 years. So you'll notice when traders had a position like this here in 2007, the Swiss franc was closer to a low than a high. Then you can see when it flipped on the other side, Swiss franc was closer to a high than a low. Swiss franc has high correlations to commodities. So you can see when the franc peaked in 2011, that's when the CRB peaked. That's when crude oil started struggling. That's when gold peaked. That's when silver peaked. And so we've tried to share for several years. And we came out in September of, it's hard to believe, 7 years ago, that in September of 2011, we shared that gold should be flat to down for years to come. And it was because of the positioning of the Swiss franc of traders, and that the Swiss franc was up against long-term resistance. And it's come true that the metals have struggled then, but you'll see that now the hedger's position is the most extreme since 2007 at this black arrow. So historically, the franc has been closer to a low than a high when traders are positioned like this. That's why Sentiment Trader tried to share that there was a bullish looking opportunity in the Swiss franc. So now here's a look at the Swiss franc over the last 17 years. And the Swiss franc has been in this these two middle lines, or this rising channel. The majority of the last 15 years, it's been inside these two trading ranges. It's at the bottom of the range, testing the lows of 2016, 17, and where we are now. A small rally has taken place. It hasn't proven anything. But if the franc would break out at 2, it would send a positive message to the metals complex. Now, the one thing that, when we saw the guy yelling into the phone that he didn't want the dollar to be making an inverse head and shoulders, commodity bulls don't want this pattern to be a head and shoulders topping pattern in the franc. Commodity bulls don't want this to be a left shoulder, a head, a neckline, and an incomplete right shoulder. So if the Swiss franc would peel down here and break support it would just suggest that the long-term trend in commodities is going to continue to go lower. So this is a really big test, an important chart that I want you to keep focused on for asset allocation models and what type of commodities to own or to continue to stay away from. So wanted to update the silver gold ratio. When this ratio is going up, it would represent that silver is doing better than gold, but would also suggest that probably both metals are doing well. You can see the ratio is down here towards the lower end of the range where significant rallies have taken place. This is a monthly look at the ratio, and so this month it's trying to push higher. So in other words, silver is acting better than gold of late. This is not in and of itself enough positives to just say, hey, let's load up the bandwagon or load up the truck on the metals. But if the metals are to head higher, this is an indicator that you'd want to see heading higher as at least a starting influence to how things are doing. So a little bit of a positive message here. And then moving on to just strictly silver, you can see that for a few years, silver has really went nowhere. It's frustrating both the bulls and the bears as this pennant pattern continues to compress and bore and compress and bore. There's a small rally that's taken place in silver just of late, has it now kissing dual resistance at 1. So again, I'm going to bring it up again. The Boy Scout motto is, if you're open to being long metals, just be prepared that if a breakout takes place, you could see a significant amount of purchasing come in, and the rally could be significant. We're not seeing indicators yet that it's proven that we should load up the truck by any stretch on this, but I want you to have something in mind as far as if there was a breakout, am I going to buy it, yes or no? If the answer is yes, if you are going to buy it, think about your percentage of asset allocation that you would commit to this, because it could catch you off guard. There's not tons of bulls on silver right now, but again, like we saw last week in copper, when it did break out from a compressed pattern, it gained several percent quickly. So be open-minded and prepared if silver breaks out what you might do. This is a look at the DBC Commodities ETF that we own. You can see that it continues to rally above rising support, but it also has dual resistance that came into the highs of 2015. This is a weekly chart, so you can see about a month ago or so it kissed the 2015 highs, created a bearish reversal. For the most part, it's been soft since then, and you have rising support coming into play. So a key test, obviously a break of support would be negative for DBC, and if it does break, our stop would take us out of this position. If DBC would break above the 1835 level, it could rally probably 5 or 6% fairly quickly, and I would probably increase my exposure to it if that took place. So a fairly tight jam that we're prepared on. I know what my game plan is. We'll just see how it pans out. So one of the things on that, one of the assets on the sentiment trader list was that there was a bullish situation set up for the Canadian dollar. So I just wanted to share, this is the ETF FXC, which is a Canadian dollar ETF. You can see that the trend's been down since last September. This was the lows of earlier this year. But we do have a 2-year rising support line coming into play, falling resistance. So I didn't include the chart from Sentiment Trader on the positions of the traders, but just take my word that right now that more often than not, the Canadian dollar is closer to a low than a high based upon where the traders are right now. So if you're hello to the members that are coming to us from the north of the border, we appreciate your business. If you're in Canada and the Canadian dollar would break out here, this would be a positive for several assets. And historically, everyone, if you see the Canadian dollar higher, there's a fairly decent correlation to commodities. So again, another key indicator for the commodities complex is really in a tight jam that we're probably going to know a lot in just the next few months, where commodities could be at the end of the year based upon one of them being the Canadian dollar. So as we get close to wrapping up here, wanted to share, this is the sentiment from the bond market, and you can see that several different bond indicators have this sentiment that's set up that bonds are typically closer to a low than a high, and yields are closer to a high than a low. So I just kind of wanted to get to kind of wrap things up on the test of the 10-year yield. So despite all the talk that interest rates are going up, in which they have for the last 2 years, interest rates on the 10-year yield are no different than where they were 4 to 5 years ago. So in 2013-14, you can see where yields peaked, and they're almost where they are right now. So for the most part, from 2012 to currently, this blue shaded area reflects that the 10-year yield's in a sideways trading range. So it's now testing the top of the range, while momentum is now the most overbought since 2000. So you can see it's above where yields peaked in 2006 before the financial crisis, started. So big test is taking place. Just because momentum's high doesn't mean that yields can't break out. But if anything, yields would deserve a little bit of a break here. So almost on the opposite side is the dollar could be making an inverse head and shoulders. The Swiss franc could be making a head and shoulders. There's a chance that, what if it's incomplete for sure, but what if that's a left shoulder, this is a head, and this is a neckline right through here with momentum very overbought. So despite a lot of choppy action in many assets, I think these patterns that are taking place over the last 100 days, 130, 40 days are going to come to mean really important things towards the end of the year. So I want to keep reminding while we're in these trading ranges with the 261 Fibonacci levels overhead until broken, that's the 800-pound gorilla. Be patient. You can see that we're trying to make selective positions and trying to take small positions, just trying to be patient until this thing, breaks out. But as a reminder, as we get close to finishing this up, this is the seasonal stocks that have typically done well in the month of June over the last 10 years. But here's a reminder that the median return of the S&P in the month of June is a negative 1.25. But there are some stocks that have done decently. But a lot of the months list that I share with you, the numbers are much higher, in a lot of the winners of the S&P stocks in any given month. So you can see that the best performing stock in the month of June or the last 10 years has been EW. But one thing I want you to notice from a sector perspective, we got healthcare once, twice, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So over 60% of the stocks that have done well in the month of June or the last 10 years have been from the healthcare sector. So I'm really watching that closely, despite the numbers not being really huge. But I like a couple of the patterns, and Edwards Life Sciences we picked up a couple of days ago. You can see that its median return for the whole month of June is 6% on average. But you can see this appears to me to be potentially a bullish ascending triangle with an attempt to break out to the upside. 2 days doesn't prove a darn thing, but we bought it a couple of days ago. It's up almost 3% in 2 days, so it's gained in 2 days almost half of its median gain for the entire month of June. So the red line represents the stop. So I just put the stop below the prior highs back in March. But so far, some nice price action is taking place in EW, a traditionally strong stock. And then another stock on the list that was toward the bottom, Humana, the average June gain was like a whopping 2%. So it's sure nothing to write home to mom about, on its gains. But again, it's from the sector being healthcare that's oftentimes strong in the month of June. Looks to be a potential bullish ascending triangle with Humana attempting a breakout to the upside this week. And so just wanted to share that if this pattern is true, if it breaks out, the measured move would suggest that Humana could rally up to around the 330 level, and it's currently trading around 300. So again, I think we just owned the stock less than a couple of days. The average gain in the month of June for Humana is a couple of percent, and so far it doesn't prove a thing. But we're up a couple of percent already in a couple of days, on this position. But the bottom line is, forgetting June seasonality, forgetting the numbers, what they have or haven't gained in the month of June, both EW, Edwards Lifesciences, and Humana appear to be forming bullish ascending triangles and attempting to break above prior highs of a few months ago. And for all of you that have been members through last year, that was one of the probably 70-80% of our trades were based upon the same pattern that you're seeing here. Because everyone, 2/3 of the time, these lead to higher prices or breakouts to the upside. So these continue to be one of our favorite patterns in an uptrending market. So I'm not a trader of Bitcoin, but just for any of you that do, I'm going to finish the webinar on Bitcoin. There's no doubt that Bitcoin has spent the majority of the last 4 years, this is 2014, in rising channel 1. The trend remains up for Bitcoin, but as we've just been talking about bullish ascending triangles, there's a chance as Bitcoin kissed the top of this rising channel at the beginning of this year, there's a chance it's creating the polar opposite, a bearish descending triangle, which is flat bottoms and lower highs. So if Bitcoin would break support of those lows, the measured move would suggest, and you can see yesterday when I made this chart that Bitcoin was trading around 6,700, that if it would break support, the measured move would suggest that it could decline to around the 2,000 range. That's not my prediction. That's just how these patterns work out. So if you are long in this sector, I would just be aware of this pattern. I don't make this pattern. Billions of free-thinking people do. So again, this support line or zone has been in place and tested a few different times. So in my humble opinion, Bitcoin bulls would not want to see the support line be taken out, because if it does, it could see a significant sell-off. So I want to thank all of you for your membership. I want to wish all of you a great summer. Summer doldrums may be in play or whatever, but that doesn't mean that opportunities don't exist. I believe that they have, they do, and they will. So I want to wish you a great summer. Any of you traveling, be safe. Have a great time, with your family. And we'll see you in a few weeks for the Connect series in the 1st of July. So take care, everyone, and thanks again. Blessings to everybody.